Hello, everyone. My name is Kyle Killen. In my capstone presentation, I'm presenting Thermo Fisher Scientific. Before we get into the financials and the strategic issues with Thermo Fisher Scientific as a company and their decisions, just giving a little bit of background is important. So they were founded in 2006 in a merger between Thermo Electron Corporation and Fisher Scientific International. So they've been around a fairly long time. They have a very diverse product portfolio due to a lot of their mergers and acquisitions throughout the decades, which we'll get into a little bit more in the presentation. And they do offer a mixture of products and services in the life sciences sector. They've been around almost 20 years at this point, and they operate in four major business segments: the life sciences solutions, analytical instruments, a lot of any of your laboratory equipment, things of that nature, specialty diagnostics, and finally, laboratory products and services, which are, again, very important in the life sciences sector. So getting into the strategic issue with Thermo Fisher Scientific. The issue being analyzed today is going to be the company's reliance on mergers and acquisitions for their product expansion and growth, rather than relying on organic growth of the current entities they have. So they're placing a lot of emphasis on spending large sums of money. We're talking billions of dollars on acquiring new companies that are currently producing different products or services. And this is really putting a strain on their financial flexibility. So you'll see a little more in the presentation, the long-term effects, the potential long-term effects of this. Looking at the external environmental factors that influence the decisions that they make every day. In the industry segment, so obviously the industry that Thermo Fisher Scientific is in is the life sciences sector, responsible for, scientific development. This industry is actually increasing in size every year by 10.8%, and is eventually expected to be worth around $330 billion by the year 2030. Some of the environmental factors that actually influence the decisions that they make, limiting and reducing their greenhouse gas emissions, because the life sciences sector actually emits more greenhouse gas emissions than that of even the car industry, just because of how much power and resources it takes to run a laboratory and those manufacturing facilities. Another brief environmental factor is the scientific testing on animals. So that it has caused them some controversy in the past. Their top competitors include Abbott Laboratories, Danaher Corporations, and Agilent Technologies. All of these competitors are producing products either similar or exactly the same as that of Thermo Fisher Scientific. And due to the wide variety of products that Thermo Fisher Scientific offers, they do have a lot more competitors than this, but these are just the top competitors that we're going to focus on today. Some of the more external factors, the driving force behind the industry, one of the driving forces, I should say, is the rapid technological advancements. So as technology continues to rapidly advance, Thermo Fisher Scientific needs to make sure that they adopt a lot of this technology to be more efficient, and to make sure that they're constantly at the cutting edge of scientific advancement. Otherwise, they may risk lagging behind and losing a lot of their market share. And then the prices of medical services and drugs is also becoming a driving force, because as the prices of drugs and medical services and medical equipment increase, it's becoming more difficult for customers to actually purchase the products from Thermo Fisher. So just keeping a lot of that in mind when making decisions. Of the Porter's five forces, the one that is exuding the most pressure to Thermo Fisher Scientific is actually the rivalry among competitors. There are so many competitors in this industry, and competition so fierce, and everyone's constantly fighting for market share and to make sure that their product is the one that is the most innovative, the most cutting edge. So just making sure that they're able to innovate and diversify is so important to Thermo Fisher's future success. So they have a very high research and development investments. We're talking, again, around $1 billion a year in research and development, so that they can constantly stay at this point in the market. And just having a very diverse product and service portfolio is also very important for them as well. As far as how attractive the industry is, life sciences sector is actually a very attractive sector to potentially join. It's very difficult. The barrier to entry is very high because of how fierce the competition is. But once you get into the industry, it is a very attractive field. So it is growing at a rate annually of 10.8%. And the current industry value is around 144 billion. And the estimated industry value by the year 2030 will be 330.07 billion, which is an incredible jump from where we're at right now. So the total, industry value is there. The market value is there. It's just a matter of capitalizing on it. And some of the critical success factors that allow Thermo Fisher to capitalize on it is their diversification of their portfolio. They have so many products that they offer that they're able to be a one-source supplier for a lot of these companies, a lot of their customers, which is very attractive for the customers. So in addition to focusing on customer satisfaction and providing services such as like maintenance, calibration on the machinery or equipment that they sell after the fact, um, really makes them a very strong competitor in the industry and drives their success in the industry. Focusing on making sure the customers are satisfied and that you're supplying products customers want is very important. The mission of the company. So, through a product diversification strategy, the company's mission is to enable their customers to make the world a healthier, cleaner, and safer place. This is pulled directly from their mission statement on their website. They want their products to make the world a healthier, cleaner, and safer place, ensuring that future generations are able to stay healthy and enjoy the environment. So focusing on sustainability and making sure that their products are sustainable is very huge emphasis for the company, and that is like their mission for the company. In addition, so their corporate culture and their values, they like to emphasize creativity, innovation, and mutual respect among the employees, which you would like to see in almost every corporation, but unfortunately, that isn't necessarily the case. They like to emphasize and encourage their employees to share their perspective, to share their ideas, so that the best solution to a complex issue can be created. Because going at a problem from one perspective is not necessarily going to yield the best results. And they have a common set of values that they like to call the 4 I's: integrity, integrity, intensity, innovation, and involvement. They like their they like their employees to operate with integrity, have an intense passion for what they're doing, think creatively so that they can constantly be innovating, and like to be very involved in the company. Looking at their strengths, weaknesses, opportunities, and threats in a SWOT analysis, one of their biggest strengths is just their strong product portfolio and their positive reputation for producing high quality products and services. Being around since 2006, they're very, very heavily positioned in the industry, and just having such a diverse product portfolio ranging from laboratory equipment to pharmaceuticals to cell gene therapy, diagnostics. They are able to offer something to everyone. They also have a strong presence in the emerging markets, such as Asia Pacific. They've opened up a bunch of new factories in this, new manufacturing facilities, and just partnerships with other corporations already in that market. And then some of the weaknesses, as I mentioned or alluded to earlier, they have very high levels of short-term and long-term debt. So this is going to be an issue for them as far as their financial flexibility. They aren't able to take advantage of unexpected opportunities. A lot of their spending has to be planned out because they don't have a very large financial flexibility. Opportunities, the market's growing. The market's going to be worth around 330 billion by 2030. So there's a lot of opportunity to innovate and create and grab market share. So expanding into expanding into some of the new markets like cell and gene therapy, that's another opportunity because these are not heavily researched yet. So making sure that they can maybe innovate in this regard is very important. A threat, the fierce competition, that's just a large threat for everyone in this industry, but especially, Thermo Fisher because they are trying to remain on top. They are trying to remain as one of the leaders. So making sure that they're able to innovate and making sure they're able to take advantage of opportunities will help them navigate these threats. Some of the internal factors, one of their core competencies is their diverse mix of quality product and services. Being able to be a one source supplier for a lot of these customers is something that is very important because being able to get multiple products or services from one supplier makes their lives easier and allows them to focus on, the point of their business. They have strong supplier relationships and they're heavily investing in inbound and outbound logistics. So they want to create a very efficient and timely distribution network so that their customers are always getting a quality product that's intact and they get it on time when they need it. The way they differentiate themselves from the competition is through their merger and acquisition strategy. They constantly are acquiring new companies, new businesses to expand their product portfolio and be more attractive to the customers. And again, that's how they grow their merger and acquisition strategy. In 2013, they acquired Life Technologies and actually expanded internationally into the Asia Pacific market with that acquisition. And then also through organic growth. They did develop their own manufacturing plant in Singapore in 2019. So they are building manufacturing plants themselves, but a large part of their strategic plan is buying and acquiring new companies. Again, they identify areas that are lagging in their portfolio and they merge with a company that fills this need. But there is a significant increase to long-term debt despite their increase in product offerings. So there is a give and a take. They opened another manufacturing plant in Singapore in 2019, and they even partnered with Chiogen in 2020 to increase their diagnostics portfolio, which is very important for them. And then organizational structure. So they do have 4 main business segments, as I presented earlier: the life sciences solutions, analytical instruments, specialty diagnostics, and laboratory products and services. As far as their code of ethical business conducts, they put an emphasis on conducting business ethically and with integrity. And they have annual ethics training programs for all their employees to make sure that they are adhering to these regulations. They want to focus on lowering their greenhouse emissions, and they actually do release and review a corporate social responsibility report annually and review that with shareholders and higher ups in the company to make sure that they actually are enforcing and progressing towards becoming more sustainable. CEO Mark Casper, very important to the company, as he has actually led a lot of these mergers and acquisitions that have led to their expansion and their financial success. Whereas the vice president and chief operating officer, Mark Stevenson, he focuses more on making sure that their organization as a whole emphasizes teamwork and personal development. Looking at their financial analysis, from 2018 to 2022, there is a massive jump in revenue due to their acquisitions. But if you look at their debt to equity ratio, unfortunately, that's also increasing with these acquisitions. And then comparing them to their competitors, their revenue numbers are about the same. The cost of revenue is significantly higher, and their gross profit margin is actually lower than both Abbott Laboratories and Danaher Corporations. But looking at their debt to equity ratio down there, it's actually 30% higher than that of Abbott Laboratories and even higher than that of Danaher Corporation, which is very alarming, especially given the fact that their revenue is very similar. So just finding a way to lower that is very important because it's so high. The life sciences sector is a growing and expanding industry, and the company is currently in a very strong financial position. But long-term continuation of their current strategic plan will severely limit their financial flexibility moving forward. So just finding a way to improve what they currently own and innovate in their current industries as opposed to constantly acquiring and merging with new companies. So relying more on organic growth and relying less on acquisitions and merger expansions will yield financial success for the company. Thank you for listening to my presentation.